Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Futures contracts are agreements to buy or sell an asset at a set price on a future date. They're a key tool for managing financial risk and speculating on price movements in commodities, currencies, and other markets. We'll break down how these contracts function and why they're so widely used. Whether you're looking to protect against future price swings or participate in market trends, understanding futures is essential. This guide will walk you through the basics, showing you how these agreements work and what makes them such a significant part of today's financial world. What exactly is a futures contract? A futures contract is a binding agreement to trade an asset at a predetermined price on a specific date in the future. Think of it like this. You're making a promise today to buy or sell something later, at a price you both agree on right now. This makes futures different from buying something on the spot market, where you pay and get the asset immediately. When you enter a futures contract, you take one of two positions. If you agree to buy the asset in the future, you hold a long position. This means you believe the asset's price will go up. If you agree to sell the asset, you hold a short position, betting its price will fall. Many different assets can be traded with futures, including commodities like oil and gold, financial instruments like stock indexes and currencies, and even interest rates. Key components of a futures contract. Every futures contract has specific elements that define it. Understanding these parts helps you see how they all work together. Underlying asset. This is the actual item you're agreeing to buy or sell. It could be anything from a barrel of crude oil to 100 shares of a stock index. The value of your futures contract directly ties back to the price of this underlying asset. Expiration date. This is the specific future date when the contract officially ends. On this date, you must either fulfill your obligation to buy or sell the underlying asset, or the contract is settled in cash. Contract size. This tells you the exact quantity of the underlying asset covered by one contract. For example, a crude oil futures contract typically represents 1,000 barrels, while a stock index futures contract might represent a multiple of the index itself. This standardization helps with trading and liquidity. Pricing. The price of a futures contract is the agreed-upon price at which the underlying asset will be exchanged on the expiration date. This price is determined by supply and demand in the futures market and can change constantly until the contract expires. These components work in tandem. The underlying asset gives the contract its purpose, the expiration date sets the timeline, the contract size defines the quantity, and the pricing determines the value of the agreement. Physical delivery versus cash settlement. When a futures contract reaches its expiration date, there are typically two ways it can be settled: physical delivery or cash settlement. The method depends largely on the underlying asset and the contract's design. Physical delivery. With physical delivery, the seller delivers the actual underlying asset to the buyer. This method is common for physical commodities like agricultural products or metals. For instance, if you hold a long position in a corn futures contract until expiration, you would be expected to take delivery of a specified quantity of corn. Conversely, if you are short, you would be required to deliver the corn. Traders often close out their positions before expiration to avoid the logistics of physical delivery. Cash settlement. Most futures contracts are settled in cash. This means that instead of exchanging the actual asset, the difference between the contract price and the market price of the underlying asset at expiration is exchanged in cash. This method is preferred for financial assets like stock indexes, currencies, and interest rates, where physical delivery would be impractical or impossible. For example, if you hold a futures contract on the S&P 500 index that expires, you won't receive 500 individual stocks. Instead, you'll receive or pay cash based on the difference between your contract price and the index's value at settlement. How futures markets operate: exchanges, clearinghouses, and margin. Understanding how futures contracts work also means knowing about the systems that support them. Futures markets don't just happen. They rely on organized exchanges and critical entities like clearinghouses to ensure smooth and secure trading. These structures bring buyers and sellers together and make sure that once a deal is made, it is honored. The crucial role of the clearinghouse. Break down the function of a clearinghouse as a central counterparty, ensuring the integrity of every trade. Explain novation. At the heart of every futures trade is the clearinghouse. This entity steps in after a trade is agreed upon between a buyer and a seller on an exchange. Think of the clearinghouse as a central guarantor. Its primary job is to ensure that both sides of a trade fulfill their obligations, even if one party defaults. Here is how a clearinghouse makes this happen. Central counterparty. The clearinghouse becomes the buyer to every seller and the seller to every buyer. This process is called novation. When you enter a futures contract, your agreement isn't directly with the person on the other side. Instead, your contract is with the clearinghouse. This removes the risk of one party failing to meet their end of the deal. If one side defaults, the clearinghouse steps in, protecting the other party from loss. Risk management. By standing between every buyer and seller, the clearinghouse effectively manages counterparty risk. It uses various tools, including margin requirements, to minimize potential losses. This system builds trust and stability in the futures market, allowing traders to focus on their strategies rather than worrying about whether their trading partner will pay up. Trade validation and settlement. The clearinghouse confirms all trades, tracks positions, and manages the daily settlement process. This involves calculating profits and losses for all open positions and adjusting accounts accordingly. This daily marking to market helps ensure that the financial integrity of the system is maintained. Without the clearinghouse, futures trading would be much riskier. Its role as a central counterparty and its robust risk management practices are what make large-scale futures markets possible and trustworthy. Understanding margin requirements and margin calls. Define and explain initial margin and maintenance margin. Discuss margin calls and their implications for traders. Futures trading involves leveraging, meaning you control a large contract value with a relatively small amount of capital upfront. This upfront capital is known as margin. Margin acts as a good faith deposit, ensuring traders can cover potential losses. You've learned the fundamentals of futures contracts and their importance. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.